In fact, I would argue that 2026 presents a cleaner entry point than we have seen in a decade, provided you ignore the noise. The strategy I am about to lay out isn't about getting rich by Tuesday. It is the mathematical path to your first 100,000 and eventually your first million, specifically designed for the economic reality we are stepping into. It starts with a number that most people are terrified to look at. Before we open the spreadsheet, I need to make a deal with you. I am going to break this down into 4 specific phases: the foundation, the engine, the portfolio, and the tax shield. This is a complete roadmap. I'm not selling a course at the end of this. The only cost of admission is your attention. If you want to treat this channel like a peer review session for your finances, go ahead and subscribe. I aim to give you the highest return on investment on your time on YouTube. Now, if I am starting at zero, the first thing I have to address isn't which stock to buy. It is the invisible anchor dragging me backward. I call this the negative compounding trap, and it is usually disguised as a monthly payment. There is a pervasive myth that you can out-invest your bad habits. I see people all the time asking if they should put money into a crypto coin or a tech ETF while they are sitting on credit card debt. They think, well, if the market does 10% and my debt is 20%, I can just catch up later. This is the financial equivalent of trying to fill a bucket that has no bottom. If I'm starting fresh, I have to accept that my net worth isn't zero. It is negative. And until I fix that, the stock market is off limits. It sounds harsh, but mathematically, paying off a 20% credit card is a guaranteed 20% return. You cannot find that in the stock market without taking risks that could wipe you out. Let's run the numbers, because feelings lie, but math doesn't. Say you have $5,000 in consumer debt at 24% interest. If you make only the minimum payments, you will end up paying back nearly double that amount over the next decade. Meanwhile, if you took that same monthly payment and invested it, sure, you might make some gains, but the interest drag is literally eating your future. In 2026, with interest rates likely stabilising but not returning to zero, the cost of borrowing is real. Every dollar of interest you pay is a dollar that isn't compounding for you. My strategy at zero is aggressive. I am not an investor yet. I am a debt destroyer. The math dictates that I must clear the decks before I try to build the house. Here is the twist that catches people. We keep debt around because it feels manageable. It is just a monthly line item, like Netflix or the water bill. We normalise it. But psychologically, debt creates a scarcity mindset. When you owe money, you are afraid to take career risks. You are afraid to ask for a raise because you can't afford to lose the job. You are afraid to move cities for a better opportunity. The true cost of that debt isn't just the 24% interest. It is the opportunity cost of the life you are too scared to live because you are shackled to a bank. Clearing this isn't just a financial move. It is a psychological unlock that allows you to play offense later. So, the protocol for Phase 1 is simple. I list every single liability from highest interest rate to lowest. I ignore the balance size, I only care about the rate. This is the avalanche method. I throw every spare dollar at the highest rate debt while paying minimums on the rest. I sell things I don't need. I downgrade subscriptions. I treat this like a hair-on-fire emergency. Once that high-interest debt is gone, I don't celebrate by buying a watch. I take that entire monthly payment amount and I get ready to pivot. But wait, before we put that money into the market, there is a massive trap that 90% of new investors fall into. You might think, okay, debts are paid, time to buy the S&P 500. If you do that, you are statistically likely to fail within 18 months. Why? Because life happens. The car breaks down. You need a root canal. If your money is tied up in stocks and the market is down when your car breaks, you have to sell at a loss to fix the car. You just locked in a loss and destroyed your compounding. We need a buffer. The common belief is that cash is trash. Influencers will tell you that inflation is eroding your cash, so you need to be fully invested at all times. While inflation is a concern, cash serves a different function in the early stages. It isn't an investment, it is insurance. If I am starting in 2026, I am building a cash fortress before I buy a single share of stock. This is my sleep well at night fund. It needs to be liquid and it needs to be boring. People hate this part because it feels like you aren't making progress. You see the number in the savings account and it doesn't move much. It feels stagnant. But that stagnation is actually stability. Let's look at the math of having a buffer versus not having one. Imagine two investors. Investor A puts everything into the market. Investor B keeps $10,000 in a high-yield savings account earning 4%. The market corrects by 20%, which happens on average every few years. Then, both investors lose their jobs. Investor A has to sell their stocks at the bottom of the market to buy groceries, locking in that 20% loss permanently. Investor B uses the cash buffer, leaves their portfolio untouched, and waits for the recovery. By the time the market bounces back, Investor A is broke and Investor B is whole. The math favours the person who never has to sell at the wrong time. There is a deeper psychological layer here. When you have 3 to 6 months of expenses sitting in a bank account, you walk differently. You negotiate differently at work. You aren't desperate. This prevents you from making emotional financial decisions. Most bad investing comes from panic, selling when things are red, or buying when things are green because of FOMO. A cash buffer creates a physiological gap between stimulus and response. It allows you to look at a market crash and see a sale rather than a catastrophe. Without this buffer, you are trading with your emotions, and the market will absolutely bankrupt you for that. The protocol here is non-negotiable. I am calculating my bare bones survival number. Rent, food, utilities, minimum transport. I multiply that by 3. That is the target. I put this money in a high-yield savings account or a money market fund. In 2026, these tools are easy to access. I automate a transfer every payday until this bucket is full. Once it is full, I pretend it doesn't exist. It is not for vacations. It is not for a new phone. It is for survival. Only when this bucket is overflowing do I look at the stock market. And this is where things get interesting, because conventional wisdom says to diversify, but I am going to tell you to focus. You have your debt paid, you have your cash buffer, now you have an extra $500 a month. Conventional wisdom says, buy a little bit of everything. Buy some crypto, some international stocks, maybe some gold. This is actually a mistake when your portfolio is small. Over-diversification at the beginning doesn't protect you, it guarantees mediocrity. We need concentration to build and diversification to preserve. The allure of stock picking is strong. We all want to find the next Nvidia or Amazon before it pops. If I'm starting in 2026, the temptation to use AI tools to pick stocks will be everywhere. Apps will promise you AI-driven alpha. But here is the reality. Finding a winning needle in the haystack is incredibly difficult, even for professionals with Bloomberg terminals and armies of analysts. For a retail investor with a day job, it is nearly impossible to do consistently. The myth is that you need to be smart enough to pick the winners. The reality is that you just need to be smart enough not to pick the losers. Let's look at the SPIVA scorecards, the data that tracks how active fund managers perform against the S&P 500. Over a 15-year period, more than 90% of active managers fail to beat the index. These are people paid millions to do this. If they can't do it, the odds of me doing it in my spare time are statistically zero.